Hi everyone, this is Michael Ben-Ghiat. This is the Market Trend Advisory Weekend Review video for August 20th, 2022. Here's our disclaimer. You can just pause the video and then read this. So there really wasn't a lot of change, just getting right into the market trend now. There really wasn't a lot of change from last week. We're still in a very strong uptrend. Our market count is 7 out of 7, so we have 100% exposure in both the NASDAQ and S&P. We have just a little bit of institutional selling days that came in towards the end of the week, but really it's pretty mild, nothing to be concerned about at this point. Both the indexes have the power trend on, which is showing that really a pretty powerful uptrend going on. The only cautionary thing, as you can see here, is for the individual stocks and non-index ETFs action signal. We just have up to 25% exposure. Reason for that is while the indexes are really just cranking along, driven by a lot of the beaten down tech stocks and the mega caps, we talked about this numerous times, more leading stocks, the stocks that are actually making new highs, not coming off of 90% lows in some cases, they're really not acting all that well. There's been a lot of volatility in our stock picks service. We just seen a lot of volatility, a lot of failed breakouts. Even the ones that are holding are really just not really going anywhere. A lot of stocks have been breaking out, but they're just coming, they're gapping out on earnings, or they're doing V-shaped runs just into earnings. Really just a lot of, makes it difficult to actually get anything and not a lot of progress. So we're just not seeing that part of the picture. So it's just still, it's cautionary on that. But for index investors, or just if you're in the beaten down stocks, you're probably doing really well this year. But we don't bottom fish. That's not our style. We're always looking to try to find the leaders, not the former leaders. So that's what most of those stocks are going to end up being, the former leaders. But again, if you're following our system using the index ETFs or QQQ and SPY, we're coming back from declines. The QQQ is still down almost 19%, and we're down about 4.15%, so it's beating that pretty good. And then for the SPY buy and hold is down about 11.12%, and we're down about 6%, so that's looking pretty good. So if we're moving on to this, looking at what's going on with the indexes, the NASDAQ, we're starting to turn over and roll over here. We didn't quite get to the 200-day moving average, which is this black line, but you can see the 50-day is turned up and the 21-day is turned up strongly. Let's look at the S&P. S&P just came up and in classic fashion just touched the 200-day, which is declining too. Remember, both these index lines are declining, so that's giving the market, the index, a little bit of a headwind there. And classic fashion, sellers were just waiting there to take some profits. So, and then the Dow actually got above the 200-day and the Russell too, the small cap Russell 2000, and they've all now closed a little bit below the 200. So this is the big question: what's going to happen here? We're going to talk a little bit more about that in a second. So let's just move on, just looking at the trend. Here's the technicals. We see the percent of stocks above the 200 is improved. We're down to about a third of the stocks are above. If you look at the other way, though, there's still 2/3 that are below. So that's really not that great, but it is improving. We came from down, I think, at 20% or around there. So this has really improved quite a bit. We're seeing the 52-week highs starting to come back. You can see here anything over 1 on the ratio. It's giving us, showing that we're having more 52-week highs. Most of this, which you can see, we had a lot below, and we're starting to come back. And we're having some strong days too, which is showing up because of the rally. In terms of the NASDAQ, it was very extended on Monday. It was 11.7% above the 50-day, usually above 7 or so. You're already getting extended. So this pullback we've had this week, really just normal action. If we were in just a regular bull market, this would be nothing to, just got a little extended and usually just continues on. But we're not quite in that mode yet. Up volume, down volume, you can see there's still, it's kind of a mixed bag. We've had some really strong up days. You can see the ones in green, and yet we're still sometimes getting some under 1 So it's kind of a mixed bag, but improving from what we were seeing before. This is a little bit confusing. I've had some people ask me about this because we're showing in our main area that for non-indexed ETFs in individual stocks, we're at 25%, but looks like this is getting really, really powerful. But the reason why this is showing so strong is it's including a lot of stocks. Now, sorry, I should back up. This column is showing the number of growth stocks, usually leading growth stocks that are broken out of a base and they hasn't failed. In other words, hasn't fallen 5 to 7% below that pivot price. But we're getting a lot of gap ups and a lot of these, as I said, big V-shaped rallies off of lows, just kind of erratic, volatile action that is skewing this to look more stronger than it really is. So that's what's going on there. In terms of sentiment, it's greatly improved. We've actually went from just a couple months ago, it was pretty much pessimism, panic at some points for the CNN, and we've actually moved to bullish, maybe just slightly neutral, but really more to bullish. So of course, that's all given the run that we've seen from this, I think it was June 16th low. It's no wonder that the technicals and the sentiment are improving. So this is the big question. We've turned down this week. The rallies had a little pause, and the big question is: the market rally over? Was that it? Or are we just getting started? So one of the first things is that it's everything to do with this market for a long time. It's very split, and so we just have you can read 20 articles. 10 of them will say that this is the beginning of a new bull market. We've already started it. We're going to new highs and beyond. Blah blah blah. And the other 10, if you read, will say, no, this is just a bear market rally. Nobody seems to know what's going on. And this confusion is just a hallmark of this rally in this market for almost 2 years now. Really just nobody would say we're not in a bubble. We're not going into any kind of bear market ever. It's only good. And of course wasn't really true. So there's three things now which we want to talk just briefly about that are all going into why this split thing. And so the first thing is that, you can argue that investors have maybe gotten too optimistic in recent weeks, because looking at the rally, it's basically an optimistic, maybe overly optimistic view that inflation's peaked and we're going to see a potentially quicker end to the rate increases from the Fed. That's what the market wants. It doesn't want any more interest rate hikes. And for the September meeting, investors now strongly expect a rate hike of just 0.5 point, but just a month ago, it was expecting a 0.75 of a point hike or 75 basis points. And of course, people that are seeing the 50 basis points, because they're the ones that are the very, very bullish, and they've kind of pointing towards look at the run in stocks. But it is possible that investors are getting ahead of themselves. This week's release of the minutes from the Fed's July meeting, it suggested a mixed view to really kind of hawkish about what the Fed is actually saying and what they're going to be doing. In one section of the minutes, it said the staff viewed the risks to the inflation projection as skewed to the upside given the persistent upward surprises seen in the inflation data. And while the Fed governors also acknowledged the risk of getting too hawkish, they pushed back on lowering rates, which is what people are already saying, hey, in 2023, we're going to be seeing lower rates. Because they're just saying in the near term, there's really no evidence that inflation's pressures are subsiding. And of course, some of the headline ones have shown, yes, we've come off, but we've come off from 8% or 9% to 7. It's still extreme inflation from any point of view of what we've seen in almost 40 years. And so during the week, a lot of the Fed governors were sort of trotted out to maybe offer some more clarity or just kind of hopefully soothe the markets. And in an interview with the Wall Street Journal, James Bullard, the president of the St. Louis Fed, said he was still leaning towards a 75 basis point hike. And Kansas City Fed President Esther George said that to know where that stopping point is, we're going to have to be completely convinced that inflation's coming down. And for her to use completely, it really is because, remember, these Fed minutes and everything the Fed says, every word is just dissected and analyzed as to what it really means. I mean, I don't know if you remember, there was a while back that inflation was transitory, and then they just took out the word transitory. And then there was a whole bunch of things that just moves the market just because they left out one word out of a statement or added one little tiny word. So, but putting the two Fed governors together, the presidents together, sorry, it's really, they're more suggesting that we're really not done with hiking rates, and we don't see anything so far to be able to just pull back or at least pause. But that's what the market, I think, is pricing in, that things are going to be rosier than they probably really are. The second thing that's, it's really already passed, is that second quarter earnings really came in quite a bit better than most people thought. It was really more better than feared. Usually it's better than expected, but we got better than feared, which kind of brought down the level of what people really thought. So about 95% of S&P companies of the S&P 500 have reported, and both earnings and sales growth came in ahead of forecasts. So that really helped push the market up as the top and bottom line results kind of cleared that low bar that people had going into it. But some of the analysts are now getting flack because they still refuse to reduce their earnings estimates. Sorry, one second. And they're getting kind of criticism that there's no way going forward, just given what many companies have said. Of course, while some have beaten, there's been many that have said we're running into problems. We're starting to reduce headcount. Earnings are not looking so great. All the different things that go into that. So that's something that may be coming up, is sort of a renewal of earning estimates going forward. Now, sorry, I skipped ahead of what I was going to say. Well, we'll come back to that in a second. Now, the last thing I want to do is say about the quantitative tightening. And in September, the Fed's going to be doubling the pace at which it will shrink the size of its $8.9 trillion balance sheet. And as it's stated back in May, it was going to start running out its $60 billion in treasuries and $35 billion in mortgage-backed securities a month. In other words, it's kind of liquidated its holdings there. And now, quantitative tightening is the opposite of quantitative easing. And quantitative easing, which really started in 2008 in the financial crisis, has been a massive tailwind for the market over the last decade, really actually in the last 14 years. And that's really, and then it really hit a massive bubble during the coronavirus when they just pumped in even more trillions, sending interest rates to zero and negative in some cases, and caused that final blow off in the crazy time we saw in 2020. And then we've sort of been seeing since then kind of a pullback and a stealth bear market in the NASDAQ, and then a bear market in both indexes in the whole market. So, excuse me, they're starting to come out in kind of estimates that just the quantitative tightening alone could shave 7 to 10% off the S&P's value from current levels. And of course, some people say, no, it's already priced in. But it's a tough one to price in because it really haven't happened yet. And also, it's something that it has no history of doing this on a massive scale like they're doing. So it's probably not priced into the market. And I think adding these two things together, the Fed hikes and the quantitative tightening, is really adding more to the risk that the Fed's not going to be able to pull off economic soft landing. And that's what the market's really pricing in right now, that there's not going to be a recession, or if there is a recession, it's going to be very mild, and it's really not going to be anything big, and it's just a blip on the radar, and off we go. So, so just kind of sum everything up. At this point, everything that the market, every report coming out and every, sort of factoid is being parsed through and all being added to the collective wisdom of the market, which is, of course, all of us, but on a bigger scale, that for whatever reason, has an intelligence of its own. And so and ultimately what the market actually is doing, not what we think it is, not if we think, well, the Fed's hiking rates and quantitative tightening, that there's no way the market can go up. Well, it can, and it can go up 100% from here. And whether you like it or not, it can do what it's going to do. And the whole key is to go with the flow, and we don't fight it. So right now, the market is it's on a big rally. It's in a very strong rally, despite all these things that are happening or are going to be happening, and that's what they call it. The market's climbing a wall of worry. Now, just coming back to this chart, we don't know if the wall of worry is going to topple over and take the market down with it. And again, nobody really knows at this point. It's all conjecture. There's just too many data points that come in day by day to know what exactly is going to be happening in inflation, whether or not it's just hit the point, whether a yield curve is going to keep inverting, all these things, it's all unknown. So for us, all we can do is just follow what the market's actually doing, which is right now it's in a strong trend. So you want to be respecting that and being on the side of that. If you're investing in the ETFs for the indexes, this will be a place, if you're not following our system, to maybe take a little off the table. The best spot would have been right here when the S&P hit the 200. That was a fantastic area to sell. That's probably where some institutions have stepped in that maybe weren't quick enough to get out when they bought over here, and now they're starting to get some of their money back at a logical area. So, that's it for about this week. We'll just come back and we'll probably be getting a lot more data during the week, and we'll see how the market's reacting to that. But again, usually the whole thing is all about going with the flow of the market, and the flow right now is up, and we'll see if that continues. And we'll know more, and we'll be back to discuss it on next Saturday. Okay, thanks.